Alright, welcome back everybody. I just wanted to make this quick little video on how I trade the 350. I believe it's an algorithm, but whether you believe that to be true or not, that's besides the point. What I've been noticing in the market lately and what I've been trading for quite a while is at 3:50 Eastern Time, or the last 10 minutes of the market, the regular trading hours, I believe the algorithm seeks liquidity. So I wanted to go over a trade I took with my chat today. It was the 521 puts. We took them from 50 cents all the way up to about $1.20, $1.25. Not a lot of drawdown, but everything was really mapped out. What I want you guys to focus your attention on really quick is, let's clean up the chart. This is SPY on a 15-minute chart. Pretty choppy day. I didn't find that many opportunities today for day trades in the basically the whole morning session. The PM session has been a little bit nicer, but what we could see here with SPY was a sweep of this high of day at 520.89. This came around 2:30 in the afternoon. What I noticed then with my chat was, once we sweep highs and once we swept liquidity up here, what is the next draw on liquidity? I always ask my chat to basically make that an important question you ask yourself. Before you get into a trade, focus on where is the draw on liquidity. Where should the market trade into next? What makes the most sense? Now, a trade that we love to take together is equal lows or equal highs. In this instance, after we had swept these morning highs that came around 10:15 in the morning, the next draw was these equal lows right here at 520.14 and right here at 520.13. So focus your attention on these two lows right here. These two lows indicate, most people consider it to be support. We bounced from 520.15 last time. The next time we trade into 520.15, we might bounce again. People like to think of this as support. I'm going to label this 520.15 and 520.13 right here, and we'll make it show on the right, relative equal lows. This will be the draw on liquidity, right? So we had swept highs. Next level is these equal lows. Now let's get rid of this and let's make our charts very clean. I want you to focus right here. This is the 15-minute chart again. This nice 15-minute fair value gap, right? And I just want to go into my chat really quick. At 3:30, I was already looking for something because I had noticed these equal lows. They were setting up for a trade for later in the day. So I said 15-minute gap above. I'll find this a 350 gem. Don't worry. Picture attached to here with the 15-minute gap right here, right? I was going to trade the 521 puts. I wanted to stay in the money, and they were pretty cheap. When I was looking at them, they were trading around 45 cents, pretty cheap. So I'll use these 521 puts for 350. I wanted the market to trade up into this 15-minute gap and then trade down into the draw on liquidity, which was these equal lows that we had already mentioned. So puts were loaded up. Alert came at 3:48, about 2 minutes before the 350 market on close order. I like to think of it as an algorithm, but same thing, that's besides the point. So let's actually go into the 1 minute time frame and see where the entry came in. So this shaded box is still the 15-minute gap. Let's go all the way to 348, right? The entry came at 348, and the reason for this and my confluence in this trade was this inversion fair value gap right here that I'll make. Let's make this like a pink color so it's pretty easy to see. As soon as this 1 minute bullish gap got voided and inverted or inversed, I took the 521 puts, and let's focus on the contract chart. I love to focus on the contract chart. If you guys know me, this is my biggest confluence when I trade options. If you look at the contract chart, what I want you guys to focus on is, this is the 5-minute chart. I'm going to draw a little fair value gap here. The high of this candle, which is 51, to the low of the next candle right here, which is, what is that, 55. 4 cents of, wiggle room. This candle closed. I want you to pay attention to this candle closed right here at 52. This candle opens up at 52. So we closed above this 51 spot that we had marked from our fair value gap. And let's make this an easy color. Let's make this like a lime green. There's our little entry box, right? Now, with an entry at 50, I put a stop loss of 37, which coincidentally was the low of day on these contracts, risking about 13 cents per contract for the trade. Now, what I also want you to understand is, let's go back to the 15-minute chart. I fully believe that the 350 market on close order, and this happens more time than none, the 350 market on close order will always target the draw on liquidity. In today's instance, it was these relative equal lows. So entry came at 348, stop loss of 13 cents. That's how it looks on the 1 minute. Also inverts this 1 minute bearish fair value gap. Oh, let me get rid of this, excuse me. Inverses this 1 minute bearish fair value gap, trades up above. Now, as the trade starts running up in profit, I like to trail my stop loss up to 45. I make it to 51 for a break-even trade. Not a lot of risk on the table. I can't really lose besides my commissions and fees. Trade plays out nicely. And the last thing I want to point out on, using the contract chart as confluence is the old highs on the contract chart are going to be the spots where you want to trim at. So just eyeballing it, you see 87, you see $1.03, you see this high at $1.17, another one at $1.32, which we didn't reach. As we trade up higher and take out these old highs on the contract chart, this is where I like to trim my position, and also I like to move up my trailing stop loss. So it makes the trade risk-free, and I'm able to hold on to my winners as long as possible. So the trims were at 89, moved up the stop loss to 75, target was hit, stop loss to 85. I wanted low of day on this trade, which we bounced by 10 cents. So all in all, it was a pretty great trade. I don't know if I could have done many things better, but I just wanted to showcase the 350 market on close order, and I want you guys to start paying attention to this, because in the last 15 minutes of the regular trading hours, you'll be able to spot opportunities like this, and you could play at the money contracts, in the money contracts. Out the money is a little bit crazy, and I like to avoid that nowadays, but the percentage return you can make and is insane, first of all, and you don't really need to risk that much per contract. Like on this trade, it was only about 13 cents per contract risk, which is feasible. I like to keep most of my trades that I take, day trades, I risk about 15 to 17 cents per contract, and I look to gain at least 30 to 40, 45 cents per contract, making every trade a 1 to 2, 1 to 3 R multiple at least. So there's a quick little breakdown, more videos to come. I appreciate you guys. I hope you guys are enjoying the video so far, and stay tuned for way more. Thank you guys so much. Take care.